Hello and welcome back to Game of Trades, your number one channel for videos on the stock market and cryptocurrencies. This video is going to be focused on the S&P 500 that's been on a crazy run throughout the past couple of weeks, recovering very rapidly from that October low we had, making a beautiful bear trap scenario followed by a type of short squeeze move here. But in this episode, I want to focus on the broader picture on the equity markets. We've been in a 12-year bull run here with the trend starting to show signs of overextension. But in today's episode, I want to focus on the broader perspective of the S&P 500 and discuss one topic in particular, the fact that we've been in a 12-year bull run here that's been fueled in large part because of low bond yields and low inflation rates. We've been in a very steady inflationary environment throughout the past decade, with inflation being consistently below 2% ever since 2009. Now we're getting a breakout in inflation for the first time since around 2007. Before then, it was 1990, and then before then, it was the 1970s. And so the combination of having seen a large bull run on the equity markets, bringing the trend much higher and valuations much higher, we're starting to see some warning signs like the real earnings yield, that's the S&P 500 earnings yield minus the CPI inflation rate, that's going negative now for the first time since 2007. You can see that's consistently been major warning signs of a market correction, a bear market, and that's what typically leads people to believe that inflation kills the stock market, because the higher that CPI inflation rate is going to be, the more you're going to see earnings yield go negative and stocks being less attractive. So we're going to discuss in this episode if that's true. We're going to discuss whether the inflationary environment that we're currently in is about to kill the stock market. Why hasn't it happened yet? Why are we not crashing? If you're interested in following these crazy markets with us, make sure to click on that subscribe button. If you enjoyed this episode, smash the like button to help us out. And now, without further ado, let's get right into it. All right, so a lot of investors use the term that inflation kills the stock market because of the 1970s. Look at this right here in around around the late 1960s, all the way till 1983 here, you had rising inflation rates, with inflation being consistently above 4 to 5%. Those are some big CPI rates, and throughout this entire period, between the late 1960s till 1983, you can see what happened with the stock market. It went sideways for a 15 to 20 year period. And if you look at the S&P 500 adjusted for inflation throughout this period, so from the late 1960s, it was at around 800 points. And in 1983 here, it crashed down because of the rising inflation rates and the fact that the stock market wasn't going anywhere. Nominal rates came down all the way to 300 points. So that's a massive drop where your return on investment throughout this period was deeply negative. So in other words, you do not want to be left holding the bag throughout this kind of period here. And that's why we have the unpopular opinion that it is important to take a look at macro trends, to know when to be buying or not to be buying the stock market. Because if you had bought in the 1960s, it would have taken you 30 years to begin earning a positive return on that investment. So inflation is here now. We're at a 5% inflation rate, and we're staying pretty consistently above that throughout the past few months. And as we're going to discuss later in the video, this is only going to increase in the next few months. So why is the stock market almost going parabolic here? Why is it not going down like it was in the 1970s period? And the answer to that question is very simple. It's actually on this chart. This is the federal fund effective rate. So a good representation of how easy monetary policy is. If rates are high, then the central banks are not lending out money very easily. They're tightening. When rates are low, that's easy monetary policy. For example, following the 2008 financial crisis, rates dropped down to zero and stayed there for quite a long period of time. So back in the 1960s, look at what was happening to this effective fund rate. It was rising consistently with inflation. In fact, let me add the CPI on this chart. You can see what that trend was. Here, the red line is the CPI, the blue line is the Federal Reserve interest rate, and you can see as inflation rises, you have the interest rate rise as well. So what was happening throughout this period was that as inflation was rising, the stock market was pricing in tighter monetary conditions. So as inflation is rising, the federal fund rate is rising as well. And so the stock market goes down because that increases the odds of a recession, and there's just less money flowing around to go into the equity markets. Now look what's happening. You have inflation that's very much present, but the federal fund rate is still flat. It's not going up. And so we have this divergence between inflation and the federal fund rate that we just did not have throughout the 1970s. So if you're an investor in this type of environment, which of course you are if you are watching these videos, what are your different options? Well, first you have bonds. This is typically the other big investment apart from the equity markets. Investors like to have a diversified portfolio of equities and bonds. Now, the problem with bonds is that the bond yield is currently at 1.5% for the 10-year yield, right? This is the treasury bond yield. So when you have an inflation rate at 5%, you don't want to be holding a bond that's only yielding 1.5%. So that's a bad investment. Your second option is cash. Cash is even worse. It doesn't yield anything. The only thing it's good for when there's inflation is to devalue. So you don't want to be in bonds. You don't want to be in cash when there's inflation. Now, a third option would be gold. Now, gold is a pretty good idea typically when you have inflation and when you have the bond yield that's extremely low like it is right now. This is the real interest rate, that blue line's at -5%. That's typically when you see gold perform extremely well. But remember, monetary policy is easy. And when you have easy monetary policy, you tend to see economic indicators go up. This is a red line showing you leading economic indicators, and it tends to go up when you're in an economic boom. We've also found this to be an incredibly accurate predictor of recessions. You can see that leading economic indicators begin to turn down before recessions. Now, typically, when you have easy monetary policy, you have leading economic indicators that go up like they are right now, and that makes profit margins go up as well. So that's good for the stock market. You don't want to be holding gold that has no return, that yields absolutely nothing during an economic boom. Now, don't get me wrong, we're extremely bullish on gold. Gold will have its time to shine, but right now, as things are currently sitting, it's still time to be bullish on the equity markets. Look at profit margins pointing up very aggressively. This is not the type of move that warns a bear market that's coming. Another chart that represents the current environment pretty well is this one here, that consumers are very confident in the labor market right now. That's typically a very good leading indicator of the actual unemployment rate. So when employment is strong, profit margins are increasing, monetary policy is easy, money is flowing around very easily, you don't want to be holding these three assets. You want to have exposure to businesses because businesses are the asset that benefits the most from this type of environment. Now, if you're smart and you're a tech investor, you have a fourth asset here that's cryptocurrencies, and cryptocurrencies are definitely benefiting from this environment that we're currently in. So you have risk off here. These are the risk off assets, and then you have risk on with equities and cryptocurrencies that benefit from this environment. And I think that's one of our strengths at gameoftrades.net, is to be able to understand this current market environment, to know how to properly take advantage of this environment, what assets are going to perform well in this macro environment, whether anything is changing in the macro environment. We look at economic data, inflation data, we evaluate the environment and how to position accordingly. If you want to be in the right assets at the right time, it's absolutely essential to look at those things. I think there's a lot of people missing out on the current equity rally, on the crypto rally, and that's because they don't understand the macro environment that's driving this crazy rally. So make sure to go and check out our website if you want to have frequent overviews of the current market environment, what's happening on different assets, and what our general macro strategy is. If you go on the investing tab, we have an entire section dedicated to the strategy where we highlight our entire thought process in the current environment. On top of the frequent articles that we make multiple times a week, we update this strategy corner every quarter so that you guys can have our full thought process for the current market environment. So is inflation eventually going to kill the stock market like it did back in the 1970s? Because right now, the Federal Reserve is just hoping that this CPI rate is going to turn back down, come back below 2%, and that they're going to be able to keep the federal fund rate near zero and never have to tighten. We don't think it's going to play out like that. If you look at this chart here, this is just an example of the type of environment that we're currently in. This is the percentage of businesses that are reporting poor sales. If the single most important problem in a business is poor sales, that's what they report. So it shows you the number of businesses whose biggest problem is poor sales. And you can see that this chart has come down to extreme lows that we haven't seen since the 1970s. And we all know what happened in the 1970s, high rates of inflation. So this is inflationary. Obviously, we just discussed the solid labor market, so employment is only going to improve in the next few months. That's inflationary. And then there's this chart that's extremely interesting that shows you the delivery times in October that is just particularly slow, and that is because of supply chain issues. When you've got supply chain issues, delivery times go down because businesses cannot have the labor, they cannot have the raw materials that are needed to produce their product or their service fast enough. And so looking at delivery times is a great way of understanding where inflation is sitting at and whether we can expect it to improve. And you can see what's happened in October. There's absolutely no improvement. It's only getting worse. If you look at everything that businesses are saying right now on the PMI updates, all businesses are talking about supply chain issues. From all the data that we've been looking at, it seems like inflation is going to stay hot throughout the next few months. And so what happens to bonds in that environment? We discussed bond yields a couple of minutes ago. Do you want to be holding bonds in this type of environment? Absolutely not. If you have a 1.5% yield on your bond and you have over 5% inflation, it doesn't make sense to be holding bonds. And so bondholders sell their bonds, and that pushes yields higher. This is exactly what's been happening since August 2020. We've had inflation appear, and so bondholders are selling their bonds because they don't want to be holding negative yielding bonds, and that's pushing yields higher, right? We have QE right now that's trying to keep rates low. We also have the federal fund rate at zero, and yet the 10-year yield is rising. That's because of inflation, and if we continue to have inflation, it's going to continue going up. Now, we do expect a brief counter-trend rally here. We discussed that, but throughout the next few months, yields are going to continue rising. And if we just draw a nice trend line here, you can see, you'll quickly understand the point I'm getting at. The Federal Reserve always seems to begin tightening as rates rise into that trend line. They tightened back in 1999, they tightened back in 2006 and 2007, and they tightened back in 2017 here with quantitative tightening. So I think the exact same thing is going to happen now. We're going to eventually see rates rise into that trend line. You're going to see the Federal Reserve begin to take a very hawkish stance here, whether they're going to raise the federal fund rate or actually do quantitative tightening like they did back in 2017. We'll see what happens, but they're going to create a tighter monetary policy, and who knows what's going to happen to the stock market when you have tight money and inflation like you did in the 1970s. That's when inflation is going to kill the stock market. I hope you guys enjoyed this video. If you did, make sure to smash that like button as hard as you can. Now, in the meantime, I wish you good luck on your trading and see you next time.